Hello and welcome to this video. In this video we are going to do a A-level question from paper 4 May-June 2024 variant 42 question 1. The question states that PMPLC is a manufacturing company. Its sales budget for 2024 includes the following: sales unit, April it is 1000, May 1200, June 1500, July 1300, August 1100. It is the policy of the company that the inventory of the finished goods at the end of each month should be equal to 20% of the expected sale in the coming month. In the bit of the question, we are asked to prepare the production budget in units and for each month April, May, June and July 2025. Now let's start with the working notes. In production budget, we usually use this formula, that is unit produced will be equal to the closing inventory plus sales minus opening inventory. So in production budget, we will have these four things, that is the closing inventory, sales, opening inventory and the unit produced. So here we will start with the opening inventory. The opening inventory will be the closing inventory of March 31st. It is given that every month at the end of the month they will have a closing inventory which will be equal to 20% of the coming month's sale. So in the month of March, the sales of April, which was given as 1000, 20% of this will be the closing inventory for the month of March. So 1000 times 20% will be 200 units. This will be the closing inventory for the month of March and this will be the opening inventory for the month of April. So in the month of April, we are going to take the opening inventory as 200 units. Then the closing inventory will be the May's month sale 20%. That is, in the May we have the sales as 1200 units. 20% of this will be 240 units. So now the unit produced will be the closing inventory, which is 240 units, plus the sales, which is 1000 units for April, and minus the opening inventory, which will be 200 units. So we will get unit produced as 1040. So now we are going to make the production budget for April. We'll start with the opening inventory, which is 200 units. Then the production or the units produced, which is 1040 units, and when we add this it will be 12,040 units. From here we will sell 1000 units, so 1000 will be subtracted. We will be left with the closing inventory of 240 units in the month of April, and this will be the opening inventory for the month of May. Now in the month of May, we know the opening inventory is 240 units. The closing inventory will be 20% of the sales of June, which is 1500 times 20%, which will be 300 units. The units to be produced will be equal to the closing inventory, which is 300, plus the sales of May, which is 1200, minus the opening inventory, which is 240. So we get the units to be produced as 1260. Now we will make the production budget, that is, we have already mentioned 240 as opening inventory for May. Then we will add the units to be produced or the production as 1260. Then from there, when we add this 2, we get the total as 1500, and from here we subtract the sales because this will lead to outflow of the units. So 1200 will be subtracted. We will get the closing inventory as 300 units. This is the closing inventory for the month of May, and this will be the opening inventory for the month of June. Now for the month of June, we will start with the opening inventory, which we have already mentioned as 300 units. The closing inventory will be the 20% of the sales of July, which is 1300 times 20%, which will be 260 units. Again, the units to be produced will be 260. That is the closing inventory, plus the sales of the month of June is 1500 units, and the opening inventory which we have is 300 units. We get the units to be produced as 1460. Now we'll make the production budget for the June. It will be 300 units as opening inventory, then 1460 as production or units to be produced. The total will be 1760. From here we subtract the sales of 1500. We get the closing inventory as 260 units. This is the closing inventory for the month of June, and it will be the opening inventory for the month of July. Now for the month of July, the opening inventory which we have is 260 units. The closing inventory again will be 20% of the sales of August, which was given as 1100 units, and 20% of this will be 220 units. The units to be produced or the production will be the closing inventory, which we have as 220 units, plus the sales of the month of July, which is 1300 units, minus the opening inventory, which is 260 units. We will get the value as 1260 as units to be produced. So now we'll start with the opening inventory, which we have already mentioned as 260, plus the production or the units to be produced as 1260. When we add this, we get 1520. From here we subtract 1300, that is 1300 as sales, and we get the closing inventory as 220 units. So this is how we make the production budget. Furthermore, we have additional information which states that the budgeted cost structure of each unit is as follows. Direct material, which is $25 per unit. The direct material are purchased on credit in the month of the production. 1/5, that is 20%, is paid in the month following the purchases after 5% discount. Another 1/5, that is again 20%, is paid for in the month following purchases but without any discount. The remainder, that is 60%, is paid for in the second month after purchase. Direct material is $30 per unit. This is paid in the month of production. Other costs, that is $40 per unit, with this are paid in the month after production, with the exception of $4, which is charged for depreciation per unit. Then in the B bit of the question, we are asked to prepare an extract from the cash budget for each of the month June and July 2025, and we have to show the payment related to the production. Now let's start with the working. We will start with the trade purchases. We need to know the productions from the production budget. For April it is 1040 units, and for May it is 1260 units, for June it is 1460 units, and for July it is 1260 units. So for trade purchases it was given that 1/5, that is 20%, is paid after a month following the purchases, and they will get a discount of 5%. That is, whatever have been purchased in the month of May, 1/5 of this will be paid in the month of June with the discount of 5%. So in the month of May, the purchases which we have is 1260 units, and 20% of this will be 252 units. And then we get a 5% discount, so 100 minus 5 will be 95%. $25 times 95% will be $23.75. So 252 times 23.75, we get the value as $5,985. Then 1/5, that is again 20%, will be paid without discount. So it will be 252, which is the 20% of May, and then we will multiply it with the unit cost of direct material, which is $25. We get the value as $6,300. So when we add this, it will be $12,285. Then furthermore, we have additional payments for the trade purchases, which is second month after purchase, we pay the 60% of the material which have been purchased. So second month after the purchase means for the month of April, whatever is the 60% which is pending for the month of April will be paid in the month of June. So it is 1040 times 60% times $25, which is $15,600. So these will be the trade payables in the month of June. Now the trade payable for the month of July. After a month following the purchases, we pay 1/5, that is 20%, and we get a discount of 5%. So the June's purchases, which is 1460 units from the production budget, 20% of this will be 292 units, and we will get a 5% discount. So $25 times 95%, which will be $23.75. So when we multiply this, we get the value as $6,935. Then again 1/5 of the June's purchases, that is 20%, will be paid without discount. So we got this value as 292 units, that is 20%, and then we multiply it with $25, which is the unit cost of direct material, and we are not having any discount here. So we get the value as $7,300. So when we add this, we get the total as $14,235, which will be paid. Furthermore, the second month after purchase, what we have to pay is whatever is remaining for the month of May. We have already paid the 40%, the remaining is 60%, and that will be paid in the month of July, because that will be the second month after purchase. So 1,260 times 60% times $25 will be 18,900. So these will be the total trade payables which have to be paid, that is 14,235 as well as 18,900 will be the trade payables which will be paid in the month of July. Next we have direct labor. All are paid in the month of production. So for the June, the production is 1,460 units and we are paying the direct labor at a unit rate of $30. So 1,460 times $30 will be $43,800 for the month of June. For the month of July, we have the production as 1,260 units and $30, which is the unit direct labor cost. We multiply this with 1,260 units, we get the value as $37,800. Then we have the other cost. All are paid in the month after production, except we have $4, which is the unit charge for depreciation. So for the month of June, the other cost will be based on the basis of the maize production, which is 1,260 units, and we will pay the unit cost for the other cost is $40, and out of this we will subtract the depreciation of $4. So now we will have the value as $36. So it will be 1,260 times $36, which will be $45,360 for the month of June. And for the month of July, this will be based on the month of June's production, because again we are paying a month after the production. So the June's production will be paid in the month of July. So here we have 1,460 units for the June's production, and then we will multiply this with $36. So we get the value as $52,560 for the month of July as other cost. Now let's make an extract for the cash budget. We need to make only for the payments. We have calculated the trade payables which are paid after a month in our first working notes. For June it is $12,285 and for July it is $14,235. And the trade payable which were paid after 2 months after the purchase, which we have calculated again in the first working notes as $15,600 for June and $18,900 for July. Then the direct labors which we have calculated in the second working notes. For June it is $43,800 and for July it is $37,800. Other costs which we have calculated in the third working notes. For June it is $45,360 and for July it is $52,560. When we total up for the month of June, we get the total payments as $117,045, and for July when we total this up, it is $123,495. Furthermore, we have additional information which states that the company usually make all its sales on cash basis for a selling price of $150 per unit. It expects to operate with a bank overdraft throughout 2025. The company has received an order from a prospective new customer who is based overseas. This order is for 900 units to be supplied in June 2025. The customer is prepared to pay $156 per unit, paying in 6 equal monthly installments starting in August 2025. In the C bit of the question, we are asked to calculate the change in the expected bank overdraft at the end of each of the months June, July and August 2025 if the order was accepted, assuming that all extra production would take place in the month in which the units are supplied. So now it is given that the extra production will take place in the month when it is supplied, and here the month in which the goods will be supplied will be June. So the production will take place in the month of June, And in the month of June we just pay the direct labor because direct labor is paid in the month of production itself. So we are producing 900 more units and the unit direct labor cost is $30. So when we multiply 900 times 30 we get $27,000, and this $27,000 will be the increase in the overdraft at the end of June. Then in the month of July, what we are going to do, we are going to pay 20% of the direct material purchase for the 900 units which have been produced, and this will be at a discount of 5%. So 900 times 20 times 23.75, we get the value as $4,275. Then 20% is without the 5% discount, so 900 times 20 times 25 will be $4,500. So when we add this, it will be $8,775. Then the other cost will also be paid in the month of July, and the rate which we have, the unit rate for other cost is $40. From there we have to subtract $4 of depreciation, so it will be 900 times 36, which will be $32,400. So when we add all this together, that is the June's overdraft which was pending was 27,000 plus the additional expenses of July, which is 8,775 plus 32,400, which were the additional payments which have been done. So when we add this, we get the total as $68,175, and this will be the increase in the overdraft till the end of July. So now in the month of August, what we have to do, we have to pay the remaining 60% of the direct material. So 900 times 60 times 25, because we don't have any discount here, so it will be $13,500. So when we add 68,175 plus 13,500, the overdraft will be now 81,675. However, we are receiving 1/6 of the sales revenue from the customer in the month of August, so it will be 900 times the selling price which we have here is $156 times 1/6. So we'll get the value as $23,400. As this is received, the overdraft will now be reduced. So from 81,675 we subtract $23,400. So the increase in the overdraft at the end of August will be $58,275. In the debate of the question, we are asked to advise the directors whether or not the company should accept the order. We have to justify our answer. If the directors accept the order, they will get the following benefit. It will be more profitable than the usual sales. Why? Because usually we are selling the product at a selling price of $150. Now with this order, we will be able to sell the same goods at $156 as selling price. Then if they have any spare capacity, this will be a good way of utilizing it. Furthermore, this will help them to enter a new market overseas. As they enter the new market overseas, their market share will also increase. Furthermore, they may get repeated orders from the overseas market. And if the costs are largely fixed, then this will help them to reduce the cost because of the economies of scale, and thus the cost will be spread over more number of units. So this will also increase the profit. There are various drawbacks if they accept the order. That is, they might not have enough capacity in the factory. The existing machines may be overworked, and this may make the machines exhausted. So they may require new machines. They require additional labor as well as material which may or may not be available. If they want to make the existing laborers work for overtime, then they have to pay them overtime wages, which will be a higher rate compared to the normal wages, and this will also increase the cost, as well as this may demotivate the workers as they are working for a longer hour. So this may also increase the overall cost of production and reduce the profit. Furthermore, they have to renegotiate their contract with the bank because they are going to finance this project by means of overdraft, and overdraft is a short-term loan. As it is given at a very short notice, it is also called off at a very short notice, and it usually have a higher rate of interest to be paid when compared to the normal loans, and this interest on overdraft will also reduce the profit. Moreover, till now all the sales are on cash terms. Now when they are entering the overseas market, they are going to sell on the credit basis. So the regular customers may also request for credit, and they have to have proper credit check of the new customers as they are going to sell on credit, and the company may have to adopt the credit control methods as well as the collection procedures to get the credit back from the customers. Furthermore, here we are having a longer credit period as we are going to get the money back in 6 installments, and this is a greater risk, and this may lead to bad debts, and this may also increase the cost for the company, and they may also have additional administration as well as delivery cost as they have to sell the goods to the customer overseas. So this will also increase the cost of the business. So overall, if we see, most of the costs are increasing, which will reduce the profit. Hence, I suggest that they should not accept this order. Instead of this, they can work more on the domestic market and have a higher rate of profitability. So with this, we have completed this question. Thanks for watching my videos and have a great life.